Using a stock screener is probably one of the most important tools that an investor can have in their toolbox. Today I'm going to use FinViz.com. I'm going to show you how to use it to find very simple criteria that you can use in your own portfolios to screen out wonderful, fantastic companies. So FinViz.com is 100% completely free. The only downside is you have to sometimes deal with pop-ups. I personally don't care about pop-ups. I just close them out. I don't really care. So even in this video, you're probably going to see some pop-ups pop up. That just comes with the territory of dealing with FinViz. But what we see in FinViz is there are almost 11,000 stocks in the stock market that we could invest in right now. We see that they're in different sectors, they're in different industries, they're even in different countries. A lot of United States stocks, but some in China, some in Brazil, some in the UK, etc. So what we're going to do is we're going to go to finviz.com, we're going to click on screener right here, and we're going to filter out some stuff that we don't want because we only want to look at certain things that are important to us in our portfolios. Okay, so for the first thing that I'm going to do, and this is not all the time, and this is not the set of screening criteria that I always use, but this is a good way of just getting started in the market. Many of us watching this video are just starting out. We are learning the ropes. That's awesome. I'm glad you're here. If you're getting any quality information out of these videos, if you're getting any value, please like and subscribe. Tell your friends. I would really appreciate that. But we have almost 11,000 stocks in total. We want to start to narrow that down. So the first thing that I'm going to do is I'm going to say only United States stocks. And what that does right off the bat is it shaves off about 1,000, little over 1,000 stocks by only looking at American stocks. Okay. Pretty much everything else is pretty good here. I'm going to go now to the fundamental tab. And this is where things get interesting. So we have all these different metrics, all these different criteria that we can filter in, filter out, whatever. Again, this is the free version of FinViz, so there might be some things that we're locked out of. That's okay. The first thing that we're going to start with is the PE ratio. Now remember, PE stands for price to earnings, and the general rule of thumb is the lower the better. So we're going to start with under 25. And if you blinked, you missed it. But that we went from 9,456 stocks down to 1,540 stocks. So just by saying we want low PE ratios, we want PE ratios under 25, that filtered out almost about 8,000 different companies. Okay. Now the next thing that we're going to do is we're going to look at the forward PE. So we would like the forward PE to be less than the current trailing 12-month PE. Again, lower the better. And what the forward PE says is based on 1 year of anticipated growth, how much of a PE ratio are you going to get a year from now based on today's current prices? So we want that to be lower. So we're going to say we want that to be under 20. Okay. And again, if you blinked it, you missed it. We went from 1,500 stocks down to a little over 1,000 stocks. So we are filtering out companies that don't fit those criteria. Okay, the next thing is the PEG ratio. The PEG ratio is very much related to the PE and the forward PE. It is a PE ratio, but we also divide it by growth. This is also something lower the better. We're going to say under 2, okay? You typically, if you can find a PEG ratio under 1, that is awesome. That should excite you. That should set off alarms and bells and put that on your watch list. But we're going to gather more stocks here. We're going to say a PEG ratio under 2, okay? Now, the next thing that we like to look at is debt to equity. Debt to equity is over here. Again, lower the better. We're going to say we want that to be under 0.4. Some stock screeners are going to call this 40%. It's the same thing. But we want that to be under 0.4 or under 40%. Basically, what that means is for every dollar that they have in equity, they have under 40 cents in debt. Why does that matter? We want companies with low debt. If there's ever a recession, if there's ever some sort of economic devastation, or if not, but the company just hits on some hard times, we want them to be able to survive that by not having too much debt to pay off. Okay, now we want their expected growth for the next 5 years of their earnings per share. So this is an annualized growth rate, okay? But for the next 5 years, we want that to be over 15%. Okay, we're not going to get too crazy and say we want things over 50 or 20%. But that pretty much does it for the 5 things that I want to talk about here. We're going to go back to descriptive real quick, and we're going to say market cap. Market cap is basically the stock price multiplied by the number of shares. It's kind of a measure of how much a company is worth altogether. Um, the small companies, those are very high risk, and so those stock prices stock prices, those are going to bounce up and down all the time. So we don't want anything too small because that means risk, that we would be incurring more risk. So we're going to say we want mid cap and higher. We want things over $2 billion in valuation. Okay. So remember, we had almost 11,000 different stocks, and now we have whittled it down to 35 different companies. Okay. A lot of these are in the financial sector. And one thing that we're going to learn on this channel at Interflame Finance, that we don't care too much about financial companies. They have their own metrics that are useful, that are specific to just the financial sector. And so if we skip those, we can see there's not a whole lot else. So there are only two companies in the technology sector. There's First Solar, a phenomenal company. We've done quite well with First Solar in our portfolio over the past year, and Dave Inc. All right, we have some healthcare stocks. We have Harmony Biosciences, BioMarin, Insight, and Excelsius. And a whole bunch of financial companies. We'll go back to the first page. We have some energy companies. We have some communication services, consumer defensive, and basic materials. Now, these are not guaranteed buys. So you should not look at this list and say, oh, I'm going to buy everything. Okay. What you should do instead is say, oh, okay, the basic materials sector. Let me now look at these 4 different companies. Okay. There's only one in communication services. And so if you feel like the sector of communication services or the industry of internet content and information is going to explode, and you think that Pinterest has a lot of growth ahead of it, awesome. But don't just use the screener to say, these are exactly the things that I'm going to buy. Instead, what you should do is use it as a tool to filter out 11,000 different companies, to boil it down to 35 different companies, to say, you know what, this is a really good place to start looking. Okay. If you want something in the energy sector, here are 4 energy companies. You may not want any of those companies. You may want to look at their competitors. Maybe their competitors offer a more intriguing thesis as to why they should get your hard-earned money. But if you have these 2 descriptive metrics, mid cap over 2 billion, United States companies, and you whittle it down by these 5 fundamental metrics: PE under 25, forward PE under 20, PEG under 2, EPS growth over 15%, and debt to equity under 40%, you will have a fantastic starting place for many, many stocks to add to your portfolio. So thanks for watching. Appreciate it. Like and subscribe if you have not done so already. We appreciate the growth of this channel. We are going to aim for a video a day for the foreseeable future to help you on your investing journey. So again, thanks for watching, and we'll see you on the next one.